where do you think that is for Aussie equity? So what number of stocks do you think gives you that balance between being a closet indexer or being taking too much risk?
So the smaller companies fund, where you're investing in small companies, and there's lots of small companies, and there's risk associated with those small companies. In fact, like for example, they're quite volatile. It's better to have more stocks. So we would have about 60 stocks in a particular portfolio. Whereas if you were doing mid-cap portfolio, you'd have less stocks in that portfolio. And then if you're doing a large-cap portfolio, you have a lot less stocks in that portfolio. And that's because the larger you get in company-wise, the less stock-specific risk you start taking on. So BHP is not going to go. Whereas I remember years ago, we had investment. It's happened so many times, but Strathfield current radio was down, 50% because of the standard. So that's why you have a diversified portfolio.
Yeah, a lot more gap risk around earnings and other events with small caps.
Yeah,
so
that's right.
Would you equally weight the portfolio, or market cap weight, or risk weight? So how do you think about position sizing in your portfolio?
There's a certain amount of art rather than science in that. I mean, there's science when it's determining, art and science when it's determining whether a stock's good value. And then all models are as good as really in future determining future profits it's all about, I suppose, the numbers that go in. It's about determining the future. It's always hard to determine what the company's going to make. But what's important is that you do diversify the portfolio, but you will weight stocks according to the risk of and volatility of a particular stock, and that's about how certain you are about what the company's earnings outlook is and what the upside valuation is. So you'll have 5 to 6% positions in stock in small companies, 5% going to 1 or 2% to make up your 50 to 60 stocks, and the weightings will go higher as you move through the market cap range of the size.
Okay, so if I understood you correctly, the larger the stock, the greater the earnings visibility, and the cheaper the valuation, the more likely it is to be a larger position. Obviously, with a bit of flex around that, because nothing's set in stone.
Yeah, I think that's right, but there are small companies which provide big upside that are small, and like many years ago, I bought a company called Queensland Tab, which was a biggish company. It had just operations in Queensland. It was weather affected, so discounted valuation on a particular stock they bought. South Australian TAB. They were able to put most of the revenue on the front, cut a lot of costs out, and that was diversifying their weather risk as well. So the stock got re-rated magnificently. So we saw that they could do those particular the things that are telling us they had really good management as well. And so it's all about a lot of investing in companies and smaller companies. It's about working out those companies which are going to be have what they call a multiple expansion and have growth. That's where you get the big upside.
So in terms of that multiple expansion, are you looking for that on the revenue side or on the margin side, or if possible, both? How do you go about
PE multiple? Yeah, PE multiple. So the lower the PE, so the more volatile the earnings and the more uncertain you have on a company's earnings stream, the lower the multiple, right? But if you can find a company that people believe has got uncertain earnings and volatile earnings, then they will then people will pay up for people over time. Once they get more confident, then that multiple, the PE multiple, will go from, like for example, with Queensland TAB, I can't remember what the numbers were so long ago, but it went from like 10 to 20 times, so double in valuation, and it had massive EPS growth. So you get those two effects, multiplier, massive multiplier effect. And that's what our job is. Our job is to find those stocks that are underpriced, but growing a lot more than what the market is.
Okay, so in terms of the fundamentals that you're looking at to try and identify those companies where you're getting earnings growth or a re-rating, or preferably both, what are some of the fundamentals that you're looking at? How would you describe a typical Paradice company, I guess is maybe another way to ask the question.
Well, a company that's got very, what they call a very strong moat, in other words, it's protected from its competitors, a stock that is really well managed, good management, a stock that has got significant growth, not so much by my company growing, but by it growing either into other sectors or doing new things. And that's why you've actually seen it in days where you've had these companies that like an Amazon or whatever it is, that emerged from obscurity over such a short period of time. There's something significant where they've continued to grow. It's not relied on the economy. It's just grown because there's been an adoption by people on technology and moving into retail and having more logistics skills. So it's important to have good management, good moat. What they call is strong cash flows coming out, good what they call cheap. So cheap valuation. Cheap could be a whole lot of things. It could be the PE multiples, which is the price divided by its earnings per share, EBIT multiples, and discounted cash flows to return. So those kind of things go into determining if the stock is good value, and also, it's just this whole business of getting companies that have got innovative management, I suppose you say, but conservative, and people that look after the community and look after their staff. So there's a whole lot of different things that swirl around that you keep for.
Podcast is for informational purposes only. It does not constitute financial advice or take into account the particular investment objectives, financial situations, or needs of individual listeners. Listeners should consider whether any opinions or recommendations in this podcast are suitable for their particular circumstances and, if appropriate, seek professional advice, including tax advice.